In volatile markets, deciding where to invest is only half the problem. The other half is deciding where your money should wait. For investors holding US dollars, idle cash is not necessarily useless cash. It can sit between investment, wait for a market opportunity, or remain available for a future expense. But even this waiting room capital needs to be managed carefully. That brings us to the
JPMorgan.
The JPMorgan Index.
JPMorgan Standard Money Market Fund. As of 30th June 2026, the fund managed approximately $21.4 billion. To put that into perspective, that is more than the annual budget of Chhattisgarh, a state with a population of over 3 crore people. But here is the contradiction. This is a money market fund, a category many investors associate with stability. So why are institutions placing more than $21 billion into a fund whose value can fluctuate? And what does that mean for an ordinary investor? Hello everybody, I am Om and welcome to Know Your Global Fund, the series where we look beyond a fund's name, open the documents and examine what the fund actually owns, and understand where the risks may be hiding. Before we begin, this video is only for educational purposes. It is not a recommendation to buy or sell any investment. Past performance and current yields do not guarantee future results. With that said, let's get started. Today we are answering 4 questions. How does a floating price money market fund aim to preserve capital? What do its maturity numbers tell us about the risk? What does its Article 8 classification actually mean? And can an Indian retail investor realistically access it? The fund manages approximately $21.4 billion. That scale tells us something very important. This is not designed as a speculative product. It is built primarily for investors who want to hold US dollar liquidity while earning income from short-term securities. That may include institutions, corporate treasuries, and other large investors that need to keep cash available without leaving all of it sitting idle. But why would they accept a floating NAV? To understand that, think of the fund as a high security parking facility for capital. Your long-term investments, stocks, property, and business ownership are the journey. Your cash is the vehicle waiting between the trips. You could leave it in an ordinary account where it might earn little or no return. Or you could place it in a professionally managed portfolio for short-term securities. The fund aims to keep that money accessible while generating income. But unlike a bank deposit, the value of your holding is not fixed. The portfolio is valued according to the market prices of the securities it owns. That means the NAV might change day to day. That is the meaning of VNAV, Variable Net Asset Value. As of 30th June 2026, the fund reported a 70-day current yield of 3.6%. This is not a fixed return. It is a snapshot based on the income generated by the portfolio over a recent 7-day period annualized. It can rise or fall as market interest rates and portfolio holdings change. The fund generates this income through 3 main elements. First, the short-term debt securities. The portfolio does not simply hold cash. Approximately 30.4% was invested in corporate holdings, while 28.2% was invested in commercial paper issued by financial companies. These are short-term debt instruments. In simple terms, the fund lends money to companies and financial institutions for relatively short periods and earns interest in return. Several holdings listed in the fact sheet matured just 1 day after the reporting date. That shows how close some of these assets are to cash. However, near cash does not mean risk-free. The fund is still exposed to the ability of each issuer to repay what it owes. Then number 2 comes WAM and WAL guardrails. 2 important numbers help us to understand how the portfolio is managed. The first is weighted average maturity, or WAM. The fund's WAM is 103 days. WAM helps to indicate how sensitive the portfolio may be to changes in short-term interest rates. A short maturity generally reduces that sensitivity. The second number is weighted average life, or WAL. The fund's WAL was 184 days. WAL focuses more closely on how long it takes for the portfolio's principal to be repaid, without assuming that interest rate reset dates shorten the life of the security. In plain English, both numbers show that the fund operates at the short end of the market. That helps limit interest rate and credit duration risk. but it does not eliminate either one. Next comes the Article 8 ESG classification. The fund is classified as Article 8 under the European Union's Sustainable Finance Disclosure Regulation. This means the strategy promotes certain environmental or social characteristics when selecting investments. But this needs to be understood carefully. Article 8 does not mean the fund has sustainability as the primary objective. It also does not guarantee that every issuer will meet an investor's personal definition of responsible or sustainability. It is better described as an ESG consideration within the investment process, rather than a dedicated sustainable investment mandate. The portfolio is managed by Doris Grillo, Kyongsing No, and Harveer Bhalla. Their role is to balance three competing objectives: preserving capital, maintaining liquidity, and generating income. That balance is more difficult than it may appear. If the manager stretches too far for yield, credit risk can rise. If they remain too conservative, the returns may fall. And if the maturities are extended too aggressively, the portfolio may become more sensitive to interest rate changes. The fund's size may help it access a broad range of short-term institutional securities. However, scale alone does not guarantee better performance or lower risk. The term VNAV often sounds more complicated than it is. It simply means the fund's net asset value changes according to the market value of the securities it owns. The fund does not promise that one unit will always remain at exactly the same price. This mark-to-market structure creates more visible movement in the NAV, even when those movements are small. That transparency is important, but it should not be confused with safety. JPMorgan's own disclosure states that investors may receive less than the amount they originally invested. The fund's summary risk indicator is 1 out of 7, placing it at the lower risk end of the scale. But 1 out of 7 does not mean zero risk. The fund may still face credit risk, liquidity risk, interest rate risk, and market stress. The first risk is that this is not a bank deposit. There is no guarantee that the value of this investment will remain unchanged. There is also no automatic government protection, simply because the fund behaves like a cash management product. The second risk is that yields can fall. In a very low rate or stressed market conditions, the fund may invest in securities offering zero or even negative yields. That would reduce the return available to investors. The third risk is cost. The fund's ongoing charge is 0.45% per year. That charge is deducted from the fund's assets and reduces the return received by investors. The fourth risk is liquidity under extreme stress. Return to the parking lot analogy. On a normal day, cars enter and leave easily. But if every driver tries to exit at the same time, the process becomes more difficult. Similarly, during a severe market disruption, short-term securities may become harder to trade at their expected prices. The fund is designed to manage liquidity carefully, but it cannot make market stress disappear. For an investor already holding US dollars, a fund like this may serve several practical purposes. It may be used to hold the proceeds from a US stock sale while the investor waits for another opportunity. It may also be used for money intended for future dollar-denominated expenses, such as tuition, travel, or any overseas payment. It may also be used by investors who want exposure to US dollar interest rates without taking the volatility of equities or long-term duration bonds. But this is not automatically a currency hedge. For an Indian investor, the rupee value of the investment will still move with the USD INR exchange rate. If the US dollar strengthens against the rupee, the investment may become more valuable in rupee terms. If the rupee strengthens, the opposite may happen. That is currency exposure, not guaranteed protection. The JPMorgan USD Standard Money Market Fund is designed as a professionally managed parking place for large pools of US dollar liquidity. It invests mainly in short-term debt instruments. Its maturity profile is relatively short. Its reported risk indicator is low, and its size places it firmly in the institutional end of the market. But it is still an investment. Its NAV can move, its yield can change, its issuers can face credit risk, and investors can receive less than they originally invested. So the real lesson is not that the fund is a substitute for a bank account. It is that cash management itself is an investment decision. And before placing any money into any fund, even one designed for liquidity, you need to understand what it owns, how quickly those holdings mature, what it costs, and what could happen during market stress. I am Om, and this was another fund from Know Your Global Fund series. Always read beyond the label.